The time cost of selling too early. A compounding and behavioral finance perspective. Selling too early rarely feels like a mistake at the moment. You lock in gains. You avoid uncertainty. You feel smart. But the real cost is often invisible. It is not just a missed price increase. It is the loss of compounding time. 1. Compounding is exponential, not linear. Compounding works slowly at first and accelerates later. When you sell early, you interrupt. Earnings reinvestment. Dividend reinvestment. Business growth momentum. Market recovery cycles. Investors influenced by Warren Buffett often emphasize that the biggest gains come from holding exceptional assets for decades, not months. Time multiplies capital. Selling resets the clock. 2. The mathematics of lost time. Consider a simplified example. If $10,000 compounds at 8% annually, 10 years $21,589, 20 years $46,610, 30 years $100,627. Notice something important. The majority of the growth happens in the later years. Selling after year 10 does not just forfeit 20 years. It forfeits the fastest years of compounding. The cost is not visible immediately. It accumulates silently. 3. Behavioral drivers of early selling. Research shows that investors systematically sell winners too early and hold losers too long. This is known as the disposition effect, documented by behavioral economists such as Richard Thaler. Why? Gains feel good locking them and feel safe. Losses feel painful avoiding realization feels protective. Early selling provides emotional relief, but often reduces long-term wealth. 4. Myopic evaluation shortens holding periods. Research by Shlomo Benartzi shows that frequent evaluation increases risk aversion. When investors monitor daily, react to short-term volatility, fear giving back gains, they shorten holding periods. The paradox. Short-term monitoring increases the probability of short-term behavior. 5. Opportunity cost of missing outlier years. Long-term market returns are highly concentrated. A small number of days or years often account for a large portion of total returns. Selling early increases the probability of missing major rebounds, breakout growth phases, structural bull runs. Missing a few strong periods can significantly reduce lifetime returns. Time in the market is not cliché. It is mathematical reality. 6. Tax and friction costs. Beyond compounding, early selling may create capital gains taxes, transaction costs, reentry timing risk. Even if you intend to buy back later, you risk reentering at higher prices. Selling interrupts not just growth, but strategic continuity. 7. The psychological illusion. Early selling feels like risk management, but often it is discomfort management, volatility avoidance, fear of regret. Psychologist Daniel Kahneman showed that humans feel regret and loss asymmetrically. Avoiding future regret becomes more important than maximizing long-term outcomes. This shortens time horizons unconsciously. 8. When selling early is rational. Not all early selling is a mistake. It may be justified if fundamentals permanently deteriorate. Asset allocation needs rebalancing. Risk capacity changes. Liquidity needs arise. The problem is not selling. The problem is selling because of short-term emotion. The core insight. The biggest cost of selling early is not the next 5%. It is the lost decades of exponential growth. Compounding rewards patience, stability, endurance. In long-term investing, the first years test your patience. The later years reward it disproportionately. Selling early converts exponential growth into linear gains. And in investing, time is not just money. Time is the multiplier.